Okay, traders, so I'm going to go through which stats I actually look for when I am evaluating my strategy, whether this is a backtested strategy or one that I'm actually testing live, and basically what I think of each stat and why it is important to me, and also how it can help you with your trading in the future too. So you can see here, this is the MyFX book for my most recent funded account. So this has been from July the 29th through right now to the 22nd of September. So just shy of 2 months. And although it's not like a massive amount of time, it does still give us some good data that we can go through and kind of see where things are and if I can continue trading this way. And if I do continue trading this way, what is the likelihood of this being profitable in the long term? That's what we really need to understand when we're looking at our data. It doesn't matter what number you see for the yearly return. That's kind of irrelevant. You still want that to be positive, but even if that's not a number that you are really, really happy with, you can still make it a good strategy. You can still turn it into something that will make you a lot of money, because you have to remember that not every strategy is going to return 50% in a year. Some might return 10% in a year. Some might return 5% in a year. But you have to consider other factors to basically tell yourself, is this strategy worth it? Is it profitable? And how can I move forward with this? So we're going to quickly look at the overall stats. So we can see here 3 months of trading. Obviously, July wasn't a full month. And I made 10% overall. And every month we have traded this account has been profitable. You also have to consider that in July, to actually get to the stage of the funded account, I did have to make 15%. So July, I actually made 15% extra, but we can't count that because I'm just focusing on this one account. Because you're going to have a different mindset on a challenge, especially phase 1 and phase 2, to the mindset you'll have on a funded account. So that is why I do count it as a different strategy, a different trading account, rather than lumping all my trades into one account, because it just is quite messy in my opinion. And one thing that you can tell immediately if a strategy is good or not is based on the equity graph. So you can see here that we have a good equity graph, and I can show you an example of a bad equity graph in a second. If I just get up a whiteboard so you guys can actually see, because equity graph might not seem that important, but you have to consider the fact that not every single strategy is just based on the numbers. Like I mentioned earlier, you have to consider this. So we're going to show you an example of a bad equity graph. So it could be one like this. So we're going up nicely. Boom. We have a massive drawdown. Then we're going up, drawdown, boom, big drawdown. And obviously we're going up in profit slowly, but you need to think about the difference between, the high here and the low here, the high here and the low here, because you have to consider your max drawdown too. So when I'm looking at my strategy here, obviously we can see that it's going up and it's great. We have our 10% return, but what if I had achieved a 10% return with this strategy? So, 10%. Would you say that this strategy, this one here, has the same value as the one that I have that goes like this and also returns 10%? You probably more likely want to trade the one that I have rather than this one. And it's the same you can see with people in the stock market. You'll see that investments that slowly go up long term, that don't have much drawdown, people are likely to invest in those. They're not likely to panic sell, because having this drawdown here can cause you to panic. It can cause you to change your mind, to change your trading when you don't actually need to do that. So it's definitely something to think about. And what we also have to consider, like I just mentioned, is the overall drawdown. And this is something where we use to calculate, as you guys are probably aware, a lot of different stats that you actually calculate from the drawdown in relation to your max return. So something called a Kalmar ratio. It's basically your return in relation to your drawdown. So for this here, it's a very, very good strategy. I've returned 10.5% with a max drawdown of 2.5%, which means my Kalmar is over 4. So put it into easier perspective for you. every $1,000 that I risk with this strategy, or every $1,000 of drawdown, I'm returning $4,000. So let's say in a year, this is a year of profits. It means that, let's say my account started at 100K at the start of the year. The lowest account balance that I actually had on the account was 97,500, but the peak was 110,000. So you could have a strategy that is 10,000 in profit, but you have an 11% drawdown. That means you would have a negative CalMAR ratio because you've had a higher drawdown. You would have gone down to 89,000 before then going up to 110,000. So in my opinion, your return isn't as good as someone with a higher CalMAR ratio. And that's why people always speak about these stats. And you also have to consider here, expectancy, also known as expected value. And as you can see, it says expectancy tells you what you can expect to make, win or lose on every trade. The account is expected to make $562 on each trade. And this is great. I'm happy with this because it means that, let's say I enter 100 trades in a year. I know that on each one of those trades, on average, I'm going to make 0.56%. And obviously we don't have a massive sample size here. We only have 18 trades. So I'm not saying that this strategy is going to be great and it's going to have no drawdown in the future and it's just going to win. But you kind of get what I'm saying. You can look at these stats and see, oh, so this is the benchmark. This is 2.5 months in, or 2 months in. This is the stats. Then you can record that. Another 2 months later or a month later, record the stats. Oh, am I trending in the right direction? Are my stats improving? Are my stats worsening? And you can quite clearly see, oh, well, if it's staying around the same point and I'm getting profits, I'm getting withdrawals from the account, then this is a great strategy and I'm going to basically milk the profits as much as I possibly can. Whereas if you see that, let's say you have 2-3 weeks of good trading, you record the stats and you realize, oh, the next month it's actually gone downhill. My profit factor's decreased, my CalMAR's decreased, my win rate's decreased, my expectancy's decreased. It could just be a losing streak, but you also have to consider the fact that maybe there's something I'm doing wrong, or maybe the strategy just does not work anymore, or maybe there's something that you need to tweak, because you're likely only going into live markets like this account here if you have backtested data anyway. I know the strategy I'm trading. I know that I'm trading a certain time of day, a certain setup, a certain time frame, a certain pair. So there's not really any things I can get wrong. And what you also need to consider, my main aim for my trading is to increase my CalMAR ratio and it's to increase my expectancy. And the ways to actually do this, and as you can see over here, my average loss is $687, whereas my average win is $1,300, or just over $1,300. And this means that on an average loss, I'm only losing 0.68% of my account. And I'm aiming to get this number as small as possible. And the way to do this is to learn what makes your trades invalid. So that if you can avoid taking a full loss every single time you're in a trade, I know it's hard for some people. The main reason it is hard for some people is because they'll see a trade and they see their stop loss at, let's say, 10 pips, and price goes into drawdown immediately. It's broken up above the highs, and based on your backtesting, you have a high kind of chance of predicting that this trade is going to lose. But because you're in the trade, your money's on the line, you want to hold out and basically get as much hope as possible in succeeding on this trade. So what you do is you just hold out to the full loss. When it's broken structure, so the trades become invalid, but you hold it anyway because you hope it's going to win. You have so much hope in your trading that you don't want it to lose. Whereas what I do is, if I'm wrong, I want to be wrong as quick as possible and to know I'm wrong as quick as possible and get out of the markets. As a trader who's been trading for 5, almost 6 years now, I know that there will just be another opportunity tomorrow or the day after or even next week. It's not the end of the world if I don't win on this exact trade. So if I can limit my loss to less than 0.7% on average, I'm saving myself 0.3% on every single trade. And you can see here that I've actually lost 7 trades. So if you do the maths there, 7 trades times that 0.3 that I've saved on an average loss, I've actually saved myself 2.1% because all my losses are not the same size. They're not that normal 1%. So my actual return overall would have been 8%, let's say. And then that might also have meant my max drawdown was higher. So my max drawdown could have been higher than 2.5%. So as a result of not closing the trades early, when there is a reasonable market movement to actually make me do that, it's meant that my max drawdown would have increased and my return would have decreased. So my CALMA would have reduced, my expectancy would have reduced, and overall, it's pretty bad for the strategy. So if you can find a way to know when a trade is no longer going to work, and this is the exact same thing for in the winning side too. So I'm not saying just do this for losses and just hold out for hoping for winners, because my average win is only 1.35%, but it works because I have a 60% win rate. But the reason why the wins aren't at that normal 3% like an average setup is for me is mainly because sometimes when I'm in a, let's say, a long position, we break into the upside, we're going perfectly, then we break to the downside. Breaking to the downside is a clear sign that price is going to move in the opposite direction to what I'm actually trading. And if I'm looking to buy, I don't want to be in a trade that's just broken structure to the downside. If I'm using a strategy that I need a break of structure to the upside to enter the trade, how is then a break of structure to the downside keeping me in the trade? It doesn't really make any sense. So I know that if the opposite happens when I'm in drawdown, I'll close. If it happens when I'm in profit, I'll close. It's as simple as that. So those are the main stats I actually look out for, and I like to keep track of them for all my different strategies and all my different accounts. And just something that I hope you guys take into consideration, rather than just seeing a max return over a year or 5 years and saying, oh, that's good enough. Just look into the details and you might find yourself becoming a hell of a lot more profitable.